Welcome to This Explainer. I am so glad you're here. Today, we're breaking down a massive, multi-billion-dollar wipeout in the semiconductor market that literally unfolded in the span of just 48 hours on June 5th and 6th, 2026. If you were watching the tech sector that week, you know it was wildly volatile, and honestly, it caught a lot of investors completely off guard. So together, we're going to map out exactly what triggered this sudden event, why it spread like wildfire, and ultimately what it means for the future. Okay, let's dive into this. How on earth did the single most profitable, high-flying sector in the entire market just lose billions of dollars in a matter of 2 days? I mean, we are talking about absolute destruction hitting the foundational giants of our modern tech economy. Companies like Nvidia, AMD, and Intel suddenly finding themselves tumbling into a massive crater. To truly understand the sheer gravity of what happened here, we need to take a close look at the raw numbers. Section 1. The tech sector bloodbath, the numbers. You know, it's one thing to say the market had a bad day, but the data really establishes the visceral reality of this crash. Just look at this quote. The iShares Semiconductor ETF, which tracks the entire sector and goes by the ticker SOXX, experienced its worst single day since March 2020. Think about that for a second. The worst single day in over 6 years. That shock value reverberated across the whole market, actually pulling the broader Nasdaq down 4.2% on Friday alone. That made it the worst single session since April of the previous year. And this brilliantly illustrates exactly what that pain looked like. When we look at the 2-day percentage drops, the board is entirely red. Broadcom, down over 20%. Micron dropped 17%. MRVL Technology lost more than 16% on Friday alone. And the household names certainly weren't spared either. Intel and AMD both fell around 11%, while even the seemingly unstoppable Nvidia dropped nearly 6%. But what actually triggered this absolute avalanche? That brings us to Section 2, Broadcom's costly earnings miss, the trigger. The core catalyst for this entire crash actually started with just one company, Broadcom. They are an absolute powerhouse, designing custom AI chips for tech giants like Google, Meta, and Microsoft. But when they released their earnings report on Wednesday evening, things got really weird. On the surface, you'd think they had an amazing quarter. Broadcom's AI chip sales were actually up 200% year over year. Total revenue was up, profits were up. So why on earth did their stock crash 15% immediately following this supposedly great news? Now, what's really interesting about this slide is that the stock market isn't just about what you did, it's all about what you're gonna do. Notice that massive $1.2 billion gap on the chart? Wall Street analysts fully expected Broadcom to project $17.2 billion in AI sales for the next quarter, but Broadcom only projected $16 billion. And let me tell you, the market absolutely hated it. Furthermore, Broadcom held their full year 2026 guidance steady instead of upgrading it, which is something analysts were heavily banking on. Which leads us perfectly into this concept, a sell the news event. Because Broadcom simply maintained their guidance instead of raising it, those premium-paying investors who had already priced in massive, unchecked growth basically hit the panic button. When expectations are set impossibly high, even objectively good news, like a 200% increase in sales, can trigger a massive sell-off. And they sold, fast. But Broadcom didn't just sink their own ship. Section 3. The Semiconductor Ripple Effect, Market Contagion. So you might be wondering, how does one company's slightly conservative guidance drag an entire multi-billion-dollar sector down with it? Well, it's because semiconductor stocks move together like a giant school of fish. They don't trade in isolation. When traders saw Broadcom signaling potentially slower AI demand, they immediately started asking, okay, what does this mean for everyone else in the space? Take Micron, for example. They make the high-bandwidth memory chips that go directly into these AI accelerators. If AI spending slows down at Broadcom, Micron essentially loses customers. That direct contagion effect is exactly why Micron dropped 17%. And the exact same logic applies to AMD and Intel. And the crazy thing is, it wasn't just AI fears driving the panic. The sector was suddenly facing a double threat. First, you had the AI chip growth coming in below those sky-high expectations. But second, there's a brewing memory chip crisis. The research firm IDC warns that global smartphone demand could fall 13% this year. Guys, that is the biggest decline in a decade. Companies had been redirecting their chips to data centers, creating shortages for consumer electronics. And now suddenly, consumer demand is falling. Markets absolutely hate uncertainty, and having these two massive problems hit at the exact same time just created the perfect storm. Moving right along to Section 4, the jobs report twist, Macro shock. Just when the sector was reeling from the whole Broadcom situation, a massive macroeconomic plot twist arrived on Friday morning, completely turning a localized sell-off into a total market bloodbath. And that twist came in the form of this number right here, 172,000. Before the market even opened on Friday, the U.S. government released the May jobs report showing 172,000 new jobs added. Now, the expectation was only around 88,000. That is nearly double what economists predicted. Now, normally, a booming job market is a reason to celebrate, right?
Well, not exactly. Let's move to and see how this builds into a vicious chain reaction. Step 1, we get a wildly hot jobs report. Step 2, this immediately triggers Federal Reserve rate hike fears because it signals the economy is still running incredibly hot. That means the Fed might keep interest rates high or even raise them to fight off inflation. Step 3, Treasury yields spike in response, with the 10-year yield jumping to 4.54% and the 30-year crossing 5%. Which leads to step 4, tech stocks completely dump.
This bizarre phenomenon is defined right here as good news is bad news. In the current market environment, a strong economy is actually terrifying for highly rate-sensitive technology stocks. Why? Because higher interest rates mean that a company's future profits are mathematically considered less valuable in today's dollars. So investors naturally dump them. You basically had Broadcom's bad guidance colliding perfectly with a massive rate fear shock. Section 5. Bulls versus Bears Market Perspectives.
So the big question is this a massive buying opportunity or the start of a much deeper correction? Let's impartially weigh the opposing viewpoints. The bull case points out that the fundamental AI build-out is very, very real. Alphabet just raised $80 billion for it, and Berkshire Hathaway is heavily investing $10 billion into Google's AI. Plus, the S&P 500 is up over 33% since the 2024 election, and smart money options traders are already placing bets on a swift recovery. On the flip side, the bear case argues that after seeing 50 to 70% gains earlier in the year, these stocks are simply overdue for a major reset. They point to real, fundamental headwinds, like that 13% structural smartphone drop we talked about, and the looming threat of higher interest rates crushing tech valuations. And finally, Section 6, your 3 action steps. What to do next? So, the crucial point is, based on all this data, how should you actually navigate this kind of wild volatility? The main thing is to avoid emotional trading mistakes. Here are your 3 specific, data-driven action steps. Number 1, don't panic sell. Seriously, if you own quality chip stocks, a 10 to 15% pullback in a bull market is completely normal. Just ask yourself, did the underlying business actually change or just the stock price? Usually, it's just the price. Number 2, watch the 10-year Treasury yield as your early warning system. If it stays above 4.5%, expect tech pressure to continue for sure. But if it pulls back toward 4.2%, that's a sign of relief. And number 3, make a watch list and just wait for stabilization. Don't rush in trying to catch a falling knife. Set your target prices for companies like Micron, Broadcom, and AMD, and practice a little patience. Which leaves us with this final, provocative question to consider. Is this the ultimate buying window for the most important technology of our generation? Or are we witnessing the very first crack in an overinflated AI bubble? I want you to think deeply about the structural reality of the market as you watch these charts over the coming weeks. Thank you so much for joining me on this explainer. Stay sharp out there and keep learning.